So maybe you're thinking about getting the federal long-term care insurance and you're doing some research and you're finding out that it's been suspended. That's right, since December 2022, the program has been suspended, and so for 2 years you cannot sign up as a new enrollee. So why would this happen? What can you do about it? Let's talk about it next. Hey, my name is Mel Stubbs. I'm a financial planner at Christy Capital Management, and we're here to bring federal employees good retirement information so that you can make better decisions about your retirement. Long-term care planning is an essential piece of your overall financial planning. Morningstar put out an article on the 100 must-know statistics about long-term care for 2023, and here are just a few of the percentages. So what's the percentage of people turning age 65 who will develop a severe long-term care need in their lifetime? 70%. 48% of people turning age 65 will need some type of paid long-term care services. 24% of people turning age 65 require paid long-term care for more than 2 years. 15% of people age 65 and over will spend more than 2 years in a nursing home. The average duration of long-term care needed for men who require it, 2.2 years. For women, it's 3.7 years. Those statistics tell me that having some sort of plan for long-term care is important. So for many federal employees, they've used the federal long-term care insurance program. But on December 19, 2022, they announced that they were suspending the plan to allow OPM and their carrier, John Hancock, to thoroughly assess benefit offerings and establish sustainable premium rates that are reasonably and equitably reflect the cost of the benefits provided. OPM determined that the suspension of the applications for this coverage, including coverage increases, is in the best interest of the program. So as of December 19th, 2022, individuals not currently enrolled may not apply for coverage, and current enrollees may not increase their coverage. Now, the last price increase they had was in 2016, and it averaged 83%. That's a huge increase. And one of the problems with long-term care is that premiums that you're paying, they're not fixed. As new information comes in and as you get older, the premiums can go up. Now, they always advertise that they can't raise their premium on just you, but they can raise it on a whole class of people. So they can decide, everybody age 65 to 70, the price is going to be going up. So if you realize you need coverage and the federal is not available to you, then what can you do? Well, you can find outside coverage. Well, and here's some of the things about long-term care coverage that are less than ideal. The premiums with normal long-term care policies have the potential to go up. They're not locked in for the life of the policy. Now, they won't go up every year, but there are times when they can go up, and just like in 2016 when the federal long-term cares went up 83%, that can definitely happen. Another way that most long-term care policies work is that they pay out based on reimbursement, meaning you need to get the services, you need to keep the receipts, you turn them in, and hopefully they're going to be reimbursed to you. There's always things like ramps or home modifications that may or may not be covered in your policy. And so now one of the things that you can do to supplement this is that instead of doing long-term care insurance, you can use a rider on a life insurance product. You can get permanent life insurance. Nowadays it's called a fixed indexed universal life policy with a chronic illness rider. Meaning if you qualify, you can have access to the chronic illness rider. So how do you qualify? If you can't do 2 of the 6 daily functions, and it just so happens that this is the same qualification for regular long-term care policies. There are 6 daily living activities, and if you can't do 2 of them, then you'd qualify. So how is life insurance different? Well, the premium on the life insurance, that's the premium. The premium, there's a guaranteed premium rider, which means that the premium can never change. This is a big difference on how that compares to a long-term care policy. Another big difference between standard long-term care policies versus the life insurance is how they make the payment to you. With long-term care, it's generally based on reimbursement. You incur the initial expense, and then you need to keep track of the paperwork and the receipts to get reimbursed for it. The way the life insurance worked is based on indemnity. They figure out the amount that you qualify for, and they cut you a check that pays the entire year. So you now have cash in the bank. You're a cash buyer to go purchase what you need. If you need a ramp or home modification, then you can use that money that way. There's no approval before the spending. If you want to hire a family member, as opposed to a professional and use that money to pay them, you can do that. Each year you would need to get another doctor to write another letter saying that you qualify, and then you'd get another check for that year. Another difference between the two is what happens to you if you never need the long-term care, but instead die peacefully in your sleep. Well, all the premiums that you paid for the long-term care would be wasted without you and your family wouldn't be receiving anything. But with life insurance, remember, you're actually paying for a death benefit. So if you never need the long-term care piece of it and you die peacefully in your sleep, then somebody will be getting the death benefit. Somebody's going to be getting something from this policy. It's a huge difference. So if you're in the market and you're wanting to cover long-term care and you're just now finding out that the federal long-term care policies are not available to you, you may want to check out life insurance. So some other features with life insurance is that you can use it to replace the FEGLI as it gets more expensive. You can use it to replace some of the survivor benefit options. If you only want to get the 25% survivor benefit, you can use life insurance to cover the difference. You can use it to cover the long-term care. It's a very useful tool in your retirement tool belt. And as you can see here, the federal option may or may not be the best option. Check out this video right here about the 8 things that the TSP still didn't fix. Is the TSP the best option for you? Watch this video and find out. My name is Mel Stubbs. I'll see you on the next video.